Right then, good morning, folks, and it is Bank of England Day. We're going to have a look at the Bank of England, have a bit of a preview, see what we are looking at as we head into today's interest rate decision. Bank of England in a very difficult position at the moment. What we've got is persistently high inflation. We've got a strong labour market. And what we're looking at is a 13th straight interest rate hike from the Bank of England, and we still have inflation extremely strong and still pushing higher. We still have a tight labour market. Economic data is not exactly terrible out of the UK at the moment. And interest rates, as I said, 13 straight hikes in a row. But you got to think about the situation that we're in, and then you can develop a trade plan then off the back of that. But if we just have a quick look back and look at the data. And we can see this inflation print, consensus 8.2, actual 8.7. So a bit of a beat there, but is a miss on or a pullback on the previous month. So is a decrease in inflation, but still 0.5% higher than what markets had anticipated. You've got retail sales then, previous minus 1.2, consensus 0.3, but actually beat consensus in terms of consumer spending amidst the high levels of inflation. You come around to the unemployment rate on the 13th of June. Consensus was for 4%, was for it to tick up 0.1%. Actually, it ticked down 0.1%, so beat consensus by 0.2%. Which is obviously strong numbers. Then again, GDP growth struggling kind of globally at the moment. Certainly the UK, who expected to enter a recession last year, who are now, or the Bank of England said, do not expect to enter a recession this year, posting positive growth over the month of April. But I think this week's inflation print is definitely what we need to keep an eye on. You can see consensus 8.4, actual 8.7, and did not pull back from the previous month. And now that is a yearly figure, but the monthly figure, up 1.2% last month, up 0.7 this month. You look at the core CPI print, consensus was for 6.8 in terms of the yearly figure. Yearly figure last month was 6.8, so you expected the whole firm, and then that ticked up to 7.1%. So you've got strong inflation figures, you've got strong labour market figures. That's a recipe where the central bank need to continue to hike interest rates, and that's where we are at today. Now, there is currently a 50% chance that markets do, or the Bank of England do go and hike by 50 basis points. I am personally of the opinion that they should hike by 50 basis points. The fact that inflation's still up at 7, 8, 9% at this point in time is ridiculous, but that is the situation we are in. Obviously, post-COVID, we all know what happened post-COVID with the interest rates and the monetary stimulus. Then Russia and Ukraine happened, but also that the UK economy is a slight outlier, and it does have supply chain disruptions from obviously as a bit of a hangover from Brexit still. So there's a couple of things, there's a little extra thing to take into consideration when looking at the Bank of England, but that is where we are at over the course of today. And in terms of what happens then going forward, it's difficult. It is difficult. Markets are currently pricing in that the Bank of England will reach a 6% terminal rate, whereas if you look across to the US, they do not have the same inflation problems. They do still have inflation problems, not to the extent that the UK do. Same with the Eurozone, they still have inflation problems, not to the extent that the UK do. And the Fed markets are currently pricing in a 72% chance of a further 25 basis points and then done. Jerome Powell is communicating different to markets, but even then that's only another 50% increase. We'll be close to what the Bank of England do, but the Bank of England are expected to go above and beyond, or markets are pricing in the Bank of England to go above and beyond what the Fed are doing. You look at the ECB, who are expected, markets are pricing in for the 25 basis points worth of hikes twice, so for the 50 basis points worth of hikes, which would mean the Bank of England still have a fair bit more to go before they get anywhere close to a terminal rate. So a little bit difficult now, in terms of what do the Bank of England do. I'm of the opinion they need to hike 50 basis points, just judge it off the inflation figures over the course of this week. But you got a situation where 2-year fixed mortgage rates in the UK are up at 6.15% as of yesterday, obviously in the lead up to an interest rate hike today. That is a high number. That is a very high number, and a lot of people then got to increase their mortgage payments and pay a lot more per month in terms of mortgage. But then you've also got this problem, which is inflation, which is still far too high, which is still ridiculously high. Once you go back and take into account that's a yearly figure, a year-over-year figure, so that's 8.7% higher than what it was a year ago, which was like 10% a year ago, and then it was like 5 or 6% than the year before that. So cumulative, that's a massive amount over the last couple of years in terms of inflation. So the cost of goods and services within the country, which is people's day-to-day expenses, have also risen. So you've got mortgage rates on one hand, and you've got day-to-day expenses on the other hand continuing to rise. In the Bank of England, I do not envy being in their position at the moment. They need to hike interest rates to cool down inflation, and realistically I think the only option they've got left is to just hike the economy into recession, and then that decrease in activity off the back of a recession will get inflation under control. Again, that's not a good thing to hike the economy into a recession, but the situation that we are in now, with mortgage rates where they're at, day-to-day living expenses where they're at, I think that's probably the best option rather than continue on what we're doing now, because these hikes at the moment are not working. But obviously we'll have to see how that plays out and what they have to say about it later on this afternoon. Well, later on this morning, midday, the release is at, but they have not communicated to markets they will do 50 basis points, so I don't know, they won't want to surprise markets, but I think they may need to after that inflation data out earlier on. And you can see in the lead up to this, we just stick it on like a daily time frame, you can see a bit of sterling strength in the lead up to this. You can see sterling Aussie, sterling Kiwi, this is sterling euro, it's quoted euro sterling, but I just have it set this way to have sterling as the base currency on all these quotes. You look at cable, you look at sterling Swiss, you can see the upside there. You look at sterling yen, I mean a lot of that move is Japanese yen driven, but still sterling strength across the rest of them. You also see sterling CAD grinding higher as well. So over the course of this year into this release, there has been a lot of sterling upside off the back of, you see, positive economic data, probably in the midst of what markets had expected to be a recession, and now you're in a situation where they're likely to hike interest rates to a point where we may enter a recession. But in terms of what that means, then markets are expecting the Bank of England to be hawkish, right? So in order for them to come in over the top in terms of being hawkish, they're going to have to really surprise markets, right? And you're also in a situation where the more they hike interest rates, the more likely they are to enter a recession. So the more they hike into interest rates, the more likely they are to enter a recession. That is negative for the currency and negative for the stock index. So yeah, you might see a bit of short-term upside off the back of a 50 basis point hike, but I do think you struggle to sustain any meaningful upside on cable, regardless of what way this meeting goes. Do you get a spike higher and the market sell back into it, which is the reaction that we saw from the inflation data the other day. If we just get this back, yesterday, you can see this here. So that candlestick right there, that is the inflation data of yesterday morning, and you had a spike straight up and then sell back into it. I'd imagine if you do get a spike back or spike higher off the back of that, you probably sell back into it. In terms of, does it happen that quickly like it did the other day? Again, that remains to be seen. But Bank of England, they've got a lot of work to do. And the more work they do, the more they hike interest rates, the more likely a recession then becomes. And that is just negative for UK assets all around. So currency may be a little bit tricky to trade in the immediate aftermath. I think the FTSE probably a slightly easier one to trade, but that has moved down aggressively over the past couple of days, in line with that higher than anticipated inflation print. So I think bearish all around for the FTSE, and I do think bearish all around for UK related assets. I'm not in a good position at the moment. The Bank of England, do they hike interest rates by 50 basis points? I don't know, but they're certainly in a difficult position, and I do not envy them. But my opinion, bearish all round for UK related assets. Does the currency spike higher and then pop back lower? We'll have to see, but it will take a lot to surprise markets in terms of hawkishness. But inflation is an issue, data remains strong, and they certainly need to get that under control.